This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Welcome back to our second and fairly quick and easy presentation in relation to our first chapter, chapter 16 on corporation tax. Now I left you there looking at that pro forma corporate tax computation. Again, it is the case that with all these pro forma computations, whether it's income, whether it's corporate tax or any other, you should be able to, with a blank piece of paper in front of you, draft out that pro forma computation. Now those two specifically, because those are the two, income and corporate tax, that may feature, of course, those two subjects will feature as the two 15-mark written questions in section C. And one or both may well require you to prepare such a computation, so you need to know the format. So again, just sit down with a pen and paper in front of you there and draft out the pro forma computation. If you can't do that, you know you've got a weakness and you need to go back and you need to learn that pro forma. Rather more difficult in income tax there, given the different analyses that need to be done, than it is here in corporate tax. It's very simple here. The first major, and possibly for many companies, only figure is the figure of trading income, most of which work we've already done back in chapters 4 and 5, which of course you've been revising since last I spoke to you on our first session of this particular chapter. At least I hope so anyway. Other than trading income, any non-trading income, interest income and property income were the ones most likely. Again, brought in on an accruals basis, our interest receivable, and of course then our property income on a basis of rental income accrued, less allowable expenses incurred there. We also had to bring in capital gains, and those capital gains would be computed in a slightly different fashion to that which you have already computed gains for the individual, which we looked at in our chapters on capital gains tax. More of that again in later chapters. That gave us total profits. Take away, if we paid them any qualifying charitable donations, you'll be clearly told in the question whether that has happened, and you're down to TTP, your taxable total profit. So it's a pretty easy computation. Remember, we do not include dividend income within that computation at TTP. Dividend income is exempt from corporation tax. Its relevance, well, it was relevant once you've got the corporate tax calculated. It will be a simple 20% figure on your TTP. To know where and when that that tax will be payable, whether or not the quarterly instalment payment system is going to operate. That, of course, was based on comparing the profit of the company as defined, TTP plus dividend income, other than dividends from subsidiary companies, related 51% group subsidiary companies there. We compared that profit figure with the relevant profit limit, 1.5 million if you're a single company and you prepared your accounts for a 12-month period. If you've got a short accounting period, you time apportion the 1.5 million. If there is a group of companies, there are therefore related 51% group companies, then we divide the profit limits by the number of such related 51% group companies. Remember, if you had a parent company and two subsidiary companies, there are 3 companies in that group, 3 related 51% group companies. So that would allow you to determine whether the tax would be payable just at the normal date, if you recall, 9 months and 1 day after the end of the accounting period, or whether we would be talking in terms of the quarterly instalment payment system actually applying there. As I said to you, the details of the quarterly instalment payment system and how it works, that awaits us in chapter 23 when we deal with the administration so far as corporate tax is concerned. But back now to the content of this computation. Most of the work was going to be involved in terms of establishing the trading income figure. And the first couple of points here, hardly worthy to be fair of separate note, but royalties payable, royalties receivable. If you own a patent, you may receive royalties. If you are using someone's patent, you may be paying royalties. Basically, these go through as part of the trading income assessment. So if therefore you've got royalties payable, as we've said there, again on an accruals basis, we give relief in line with the accounting treatment, and therefore they'd be allowed as a deduction when calculating the adjusted trading profit. So whatever has gone through the accounts as debited as the royalty payable is allowable for taxation. We wouldn't therefore need to add it back in deriving the tax adjusted trading profit. It's an allowable trading expense. Royalties receivable, if we're lucky enough to own that patent, for example, there. Taxation of royalty receivable, again following the accounting treatment, again it's an accruals basis, and it will be included within the adjusted trading profit. So it's been credited as part of your statement of profit or loss in deriving your trading profit. It stays there. It is therefore a part of the tax adjusted trading profit. But in getting that tax adjusted trading profit, we have to know, of course, as learnt in Chapter 4 and Chapter 5, the rules of what add backs of non-allowable expenses might we have to deal with, and of course also how do we put together the capital allowances computation. So the tax adjusted trading profit is the adjusted profit less the capital allowances to give us the figure to include now within the corporate tax computation. As I've referenced there, Chapter 4 is where we dealt with the adjustment of profits so far as income tax was concerned, and also for capital allowances here was Chapter 5, where we dealt with income tax unincorporated businesses. So in this process, therefore, now of firstly adjustment of profits and then capital allowance computation, what differences do we see between what we did for individuals, unincorporated traders, and what we do now for companies? Thankfully, most of what we learned there is exactly the same, and in fact some of the harder parts of what we dealt with back in Chapter 4 and 5 will not apply here. So if anything, it's going to be easier. So what have we got? First of all, one of those differences. Most of the rules are going to stay the same, except no private use. So again, we would see things like motor expenses, rent and rates, heat and light, for example, where there was going to be an element of both allowable business use, but also private use by the proprietor. We don't have a proprietor so far as a company is concerned here. So on that basis, there's never any private use. Now again, they might try and tell you that the motor expenses were for the director, and the director had this mileage, so much business, so much private. Not relevant. The fact that the company has provided the director and employee with a company car, and that car is used both for private and business purposes, that's dealt with within, well, as you knew it, Chapter 9, the employment income assessment. There would be an assessable car benefit and maybe a fuel benefit in relation to the provision by the company of that particular car. And also then in, Chapter 11, when dealing with national insurance contributions, the company would have to pay Class 1A national insurance contributions in relation to the assessable benefits in relation there to the car. So that's how it's dealt with within the tax system. Here, adjustment of profits, there is no adjustment. There's no private use adjustments. And that also holds true, if I digress for one moment, down here in terms of capital allowances. There are no private use assets. No private use assets. So you'll not have the non-pool column for a proprietor's private use asset. So private use, gone, doesn't exist so far as corporate tax is concerned. Also here, as well as that one, drawings. Remember, again, there were adjustments of profit for a proprietor, taking goods, taking cash out of the business. Not relevant for companies as there's no proprietor. Any distributions, of course, going to the owners of the company, dividends paid to shareholders there, well, they come out of post-tax profit. So there won't be any drawings, there won't be goods taken from stock, no adjustments will need to be required, here. Nothing will be needed. Again, we already know that dividends, if they've shown a dividend paid deducted in deriving profit, Well, it shouldn't be. It's not an allowable expense, it's a distribution. Again, you won't have family salaries. You have an employee of the company can employ whoever it likes and pay them whatever they choose there, and those payments, of course, will then be chargeable again under the PAYE system to income tax, part of employment income, and of course any national insurance contributions payable by employee, by employer. So again, none of those adjustments are relevant in corporate tax. Next one, legal fees. Now, of course, individuals, unincorporated traders, don't have share capital. Companies have share capital. So legal fees regarding the issue of share capital are an expense only for companies, and as they are of a capital nature, the expense is disallowed and added back in the adjustment of trading profit. So if we have legal fees in connection with the raising of share capital, disallowed. It's an add back in your adjustment of profits. If on the other hand we have legal fees in connection with the raising of loan finance, then tax relief is available for such legal fees. The only question, as we will see in just a few minutes' time, is where the tax relief will be given. And that will depend upon whether the loan is a trading loan or a non-trading loan. So we'll come back to that one in a few minutes' time. But legal fees on the raising of share capital, capital in nature, not allowable, add it back. Next one, again, legal fees regard to registering patents, trademarks, allowable by statute. Again, that's to do with the trade and therefore will be allowed. Interest payable on, now here we go, non-trading loans are added back, but the expense is deductible instead against interest income. So if we've got interest payable on a non-trading loan and expense in taking out that loan, then those will not be allowable. They'll be added back in terms of our adjustment of trading profit. But we will get tax relief and it will be deducted instead against interest income. The expense is there, deductible against interest income. So that slot on your corporate tax computation for interest receivable has just become a little bit more interesting, there's that pun again, than you might have thought it to have been. Because what we'll have to do in establishing the interest receivable assessment is to take not just the interest receivable figure, but reduce from that, deduct from it, any interest payable on non-trading loans. Now that begs a question of what do we mean by a trading loan or a non-trading loan? It's pretty easy, and again we'll deal with the issue separate in a moment's time, but if I just go straight to that, here in relation to interest income, interest receivable is assessed accruals basis. Companies, just like now indeed individuals, they receive their interest gross. Interest payable is deducted against tax adjusted trading profit if the loan is used for a trading purpose. That's what we've just been saying. For example, now you think, why would the company borrow money? It would borrow money, for example, to allow it to buy plant and machinery for use in the trade, to buy a building for use within the trade. Now those clearly are trading loans. You might borrow money to increase your working capital, again a trading loan. Any such interest payable will be an allowable deduction against your trading profit. Whereas, again here, increase working capital, if the loan is used for non-trading purposes, then it will be deductible against interest income. Now, again, we work on an accruals basis. Main examples of non-trading loans, we borrow to buy a property, but not a property that's used in the trade. We know that property income is a separate part of our corporate tax computation. Well, if we have borrowed money to buy a rental property, then the interest payable on that loan is not a trading loan, so it's not allowable against trading income. So in your adjustment of trading profit, you would need to add it back if it had been deducted in deriving the accounting figure of trading profit. Have to be added back. It's not a trading item. You might then think, so that is interest payable on a loan taken out to get the rental property. So if this happened in income tax, the interest payable would be deducted from the rental income and would be taken account of in the net rental income assessment. That's what you do for income tax for individuals. It's not, however, what you do for companies, and it's for that reason that it often comes up in exam questions to test whether we know this. So interest payable on non-trading loans, whether that's for a rental property or anything else, as we'll see in a moment's time, such interest payable on a non-trading loan is a deduction from your interest receivable. It's referred to as part of the non-trading loan relationship rules, a term you have to be familiar with at P6 but not here. Non-trading loan relationship rules, which says the interest income assessment for the company for the chargeable accounting period is made up of interest receivable less interest payable on non-trading loans. So it's a deduction against interest income. The other main form of non-trading loan we might see is you borrow to buy shares. So if you're looking at a group of companies, you've got a parent company owning the shares in its subsidiary companies. It's had to purchase them, presumably. Where did the money come from? So if the parent company borrowed to buy shares, that is a non-trading loan, and again the same treatment applies. Just go back then to how we got into that, back to our note here on the adjusted trading profit. We've also got, we said about the interest income there and the interest payable. Interest payable to HMRC is treated as non-trading, so is also tax relievable against interest income. Remember, interest receivable from HMRC is taxable as interest income. Now, if an individual was late paying their tax and therefore had to pay interest on overdue tax, there'd be no tax relief there. If they received a repayment of interest on overpaid tax, there'd be no assessment in relation to that income. But when it comes to companies, as we see here, if we've had interest payable to HMRC in relation to usually underpaid tax, late paying tax there, then on that basis, it's tax deductible against your interest income. Again, another part of the so-called non-trading loan relationship rules, but it goes against interest income. And if you've received a repayment supplement, interest on overpaid tax, then that's assessable as part of your interest income. In income tax, that would not happen. Interest payable by the individual, receivable from HMRC by the individual, that is outside the scope of income tax. Capital allowances, as we've said, it's very easy. It was all the same rules in terms of AIA, WDA, FYA, but it's made easier because there's no private use. Again, though, watch out, the examiner will tempt you by telling you about the managing director's car and the amount of business of private use. There is no restriction on motor expenses. There's no restriction in relation to capital allowances. It's just a full capital allowance available, and based on its CO2 emissions that will determine whether it's principal, its main pool, or special rate pool item. Also here, as regards our capital allowances, one further point, only one AIA is allowable to a group of companies. So you can't therefore, when operating as a company, create new subsidiary companies to split your business between it to get another 200,000 AIA. another 200,000 AIA. It doesn't work that way. There's only going to be one AIA allowable to a group of companies. Though within that group, the group will decide itself as to where to apply that AIA. So that will be down to the company to decide who gets the benefit, down to the group to decide who gets the benefit of the available, the one lot of £200,000 AIA. Again, of course, based on a 12-month accounting period. Basis periods, yeah, we had a problem, didn't we, with income tax for the unincorporated trader. Again, probably still got nightmares over Chapter 6 and the opening year's bases of assessment. Not a problem here. So far as a company is concerned, we prepare a corporate tax computation for a chargeable accounting period. That is normally the same as the company's period of account. We don't have this problem of relating an accounting period to a tax year. That's 6th of April to 5th of April. We don't have that problem. So a company, chargeable accounting period, based on the company's period of account, profits are taxed and taxed once, and we move on to the next profit period. So we don't have a problem with bases of assessment and basis periods. Moving on here, however, to our next section. We've already dealt with interest income in there, but property income, and pretty much the same as we knew before with a few simplifications. We know that the property income assessment is going to be the rental income accrued less the allowable expenses incurred. We also know from what was Chapter 3 for the individual that an individual, or now a company, might receive a premium on the granting of a short lease. And if you're going to see that issue, by the way, it's probably here in corporate tax where you would see it. So again, go back and remind yourself about how to treat those premiums. But property income is calculated on a normal accruals basis. As we've already said, if there's interest payable on a loan taken out to buy a rental property, it is deductible against interest income, not property income. Companies, there's no rent-a-room live, doesn't have its own private name residence that it lets out a room in, so there's no rent-a-room live. And if a company makes a property loss on its properties, it must be offset against total profits. So remember what total profits are? Have a look back on the pro forma if you need to do that. That was the figure, the accumulated figure of income and gains, but before deducting, if there were any qualifying charitable donations there. Now, the company has made a property loss. First off, into the corporate tax computation for the property income assessment, nil. Remember, with losses, you never put a negative figure. It is a nil assessment that arises there. And instead, we say, so what do we now do with the loss? What we do with that loss here is simple. We set it off against total profits, which, as we've said, is before the deduction of qualifying charitable donations. This in the current period. Now, it's unlikely in questions that that property income loss is going to be bigger than the other total profits, so it should be absorbed against that profit. But if it were bigger, any excess loss carried forward again against total profits before qualifying charitable donations. Where you might see that is, for example, you're told, prepare the corporate tax computation for the company's accounting year ended 31st of March 2017, and you're then told that at the beginning of that period, year ended 31st of March 17, so at 1st of April 16, it had a brought forward property income loss. You now know that it will go against this period's total profits, and you set it off against them accordingly. Okay, so we should be able to deal with property income or even property income losses. Interest income, we don't have to deal with interest income losses. You might ask, well, how would that arise? Very simple in practice. There is more interest payable on non-trading loans than there is interest receivable. But that's not in your syllabus. That again is a pleasure that awaits you at P6. Here, if there is interest receivable and there is interest payable on non-trading loans, there'll be more interest receivable than such interest payable. You will end up with a positive assessment. Qualifying charitable donations, well, as we've said, all such donations, as long as they're to qualifying charities, will gain relief. They are deducted from total profits in deriving TTP, and they are deducted on a paid basis. Now again, back in your adjustment of trading profit, if the accounting profit that you're starting with has had already deducted in deriving it those qualifying charitable donations, then in the adjustment of trading profit, you'd say the accounting profit is after deducting that donation, add it back, because the donation is not an expense to be deducted in deriving the trading profit. Instead, as we have seen, qualifying charitable donations are deductions not just from trading profit, but from total profit. So you'd add them back in the adjustment of the trading profit and deduct them instead on a paid basis from total profits. It's got its own separate slot there on the corporation tax computation. That therefore would bring you down to TTP. As we've already stated, dividend income, of course, is not chargeable to corporate tax, not a part of TTP, though if we have dividend income from non-related 51% related 51% group companies there, i.e. subsidiaries, then we do have to add that in deriving profit, but that's a separate working purely to determine when does the company pay its tax. Is it or is it not subject to the so-called quarterly instalment payment system? Okay, last thing we've got to do, simple little exercise here, and that's just to put together our calculation of the taxable total profits for the year ended March 17, just to get you used to the presentation, the structure of this computation. In any exam question, you're going to have to find the numbers for each of those sources of income and gains. Here all it is just assembling the information in the correct format. So what have we got here? We've got a tax adjusted trading profit. Now, to begin with, before you start slapping numbers down randomly on the page, it's Westmoreland Limited is the company, and we are preparing a corporation tax computation. We'll only go as far as TTP, but for the year ending 31st of March 17. So we set that up in our answer booklets. Westmoreland Limited, corporation tax computation, accounting year ended 31st of March 17. First figure to include tax adjusted trading profit. That there is probably going to require both working 1 and working 2. The adjustment of profit statement and the capital allowances computation. So a lot of work could be going in there. If we get a corporate tax computation as one of our 2 15-mark section C questions, rather some specialised area of corporate tax, we'll talk about that later, then the majority of the marks are probably going to be given over to the adjustment of profit and capital allowance computations. Up to maybe 10 of the 15 marks available could be in deriving that one figure. We've also got property income, yeah, that will be included. Interest receivable, that will be included. We want net chargeable gains, so the gains less the capital losses. Dividends from UK companies, no, they are not to be included, of course, within your TTP. Qualifying charitable donations, well, the other figures, the trading profit, the property income, the interest income, the net gains go in deriving total profits. From total profits, we then deduct the donations, and that brings you down to TTP. Now check through with the answer in the back. It's a very straightforward exercise, as I've said, but make sure before we go any further, in terms of our next chapter, that we are able to present and to produce a corporation tax computation in the required format. Next time, in the next chapter, again a quick and easy chapter you'll be pleased to hear, we deal with a problem that we made reference to right back at the beginning of this chapter. And it was the situation where, for whatever reason, the company had prepared its accounts for a period of more than 12 months. It had what we call a long period of account. If you've got a long period of account, then you've got to prepare 2 corporate tax computations because a chargeable accounting period cannot exceed 12 months. So an 18-month period of account would create 2 corporate tax comps, the first of 12 months, the second of 6 months. But how is it that we take one statement of profit or loss, and from that one statement of profit or loss, prepare the 2 corporate tax computations? It will, of course, be by following the rules laid down for how we deal with each item to include on that corporate tax computation. So just make sure you're happy with the basic corporate tax computation before we progress to that next chapter. But I look forward to seeing you in that next chapter where we'll deal with the long period